So hi everybody, this is Hustle Hub. I'm Giacomo and today I'm going to analyze Chipotle. This is one of the stocks that you asked me to analyze. Very interesting stock. And before we get into the video of today, into the content, a few disclaimers. This is not financial advice. Do your own research. And second, the data that I've taken comes from Seeking Alpha and the New York University website, the pod managed by the Aswat Madaran, and that's where I've taken the risk premium, for example. If you want to get a good discount on Seeking Alpha, you can go in the link down below and you will find that discount on the subscription. So let's get into the video of today. First, we try to estimate the cost of equity and the cost of debt that make for the calculation of the weighted average cost of capital. So I take as a reference the interest rate swap for 10 years that is around 4% in the last few days. So I take that as a reference. Given that I've estimated the cash flows, I've taken as a reference the next 10 years for my estimations. So I thought it was fair to use that rate as a risk-free rate. Then we add the risk premium for the cost of equity, and that is taken from Aswath Damadaran's spreadsheets, and the beta that is around 1.1. And we come up with the cost of equity. Then we have the cost of debt. I've put a fairly high spread because it has a relatively high debt to equity ratio, so I wanted to take into account the risk that Chipotle could face in case it would not be able to deliver as it should. In good times, this is a really good strategy to lower the cost of capital, but in bad times it could turn out to be not ideal. So yeah, you have to take into consideration the risk of that in bad times. So here we have the calculation for the weighted average cost of capital, and yeah, next we get into some of the financials. These are the highlights of what has happened, the most important things that have happened to Chipotle in the last 10 years. We can see that the management has done a pretty good job at delivering growth. We can see the revenue has more than doubled over 10 years. The earnings, they did the same, or I think more than tripled, so good result. And the free cash flow has followed, more than doubled. So it has done pretty good. So kudos to the management for bringing these results despite the bad times during COVID and the worst COVID years, especially 2020. So next we start making assumptions for what we can expect in the future. I've taken into account a growth of around 3% until the end of the year, and then I've taken as a reference the last 10 years. I've put 8% growth for the free cash flow. Then after 2 years and a half, I in order to stay conservative, I've cut the growth at around 4%, more or less half, and then I've taken the long term. I've done the growth that is widely used for the long-term growth of the GDP of the US, that is around 3%, more or less 3% every year. So that's what I've taken as my assumptions. Then we have over here the calculation of the terminal value, and here we have the present value of that. Then we have here the sum of all the present value of the free cash flows plus the terminal value. And then we subtract some of the things that could dilute our value, such as debt, net debt position, net debt to cash, and other minor stuff. So it has almost 3 billion over here. Then we have the options, And here's the exercise price. Here I've taken the exercise price that I could find in the latest 10Ks, that is before the stock split. So I've done a little bit. I've done some calculations in order to come up with the value of options and take care of the strike price once the stock have been split. So yeah, over here, and I've taken as a reference the last share price that I found, that is $49. And yeah, so basically I multiplied by 50 and then subtracted by the exercise price, multiplied by the number of options outstanding. This figure is in millions, so that means there are almost 300,000 options outstanding. What I have to say is that I didn't use the Black-Scholes model. That means that probably this figure is slightly below what is what is the actual value of the options. But you have to remember that when companies do good, options tend to be exercised way before the expiration price, so it might be higher than this value over here, but not that higher, because the management probably would exercise sooner rather than later. Then we have the restricted stock units and the performance stock units. That is another reward for the management, and I've calculated the value of that, and I've subtracted all of that into the value of equity. So next we divide this figure over here by the number of outstanding shares, and we find the share price that is well below the current share price. As a matter of fact, I think that Chipotle is not a really good deal as of now. I think we have to say that the management has done really good at delivering growth and value for the last few years, but that doesn't mean it has infinite growth, an infinite growth path. Yeah, because it's not really, you can't really put a growth rate that would rather fit a technology company on a food and beverage retail company. So these are more conservative assumptions. Maybe we make it a little bit higher than that. Let's say it continues to grow on the same path for the whole 10 years, but it still wouldn't make the value that it has right now. So yeah, another thing, maybe we can lower the cost of capital and see what would happen. It would increase a little bit more, but yeah, I don't think that Chipotle as of now is a value play, not at all. It's not cheap at all. It operates in the retail, not in technology. We have to remember that. So I wouldn't bet on Chipotle as of now, not because the management is bad or the company is doing bad, but I think that the ratios that it's trading at right now don't really make sense given the business that it operates. And maybe, yes, it can grow the customer base by a lot, and I wish for them to do so, but I don't think that the current valuation that we see right now really makes sense, given the figures that it's delivering. It's just a ratio. I don't think that the ratio is fair. I think that kind of ratio would make sense for a company that has more possibility to grow on a longer term, and those companies are probably technology companies, not retail and food and beverage companies. So let me know what you think about this in the comments. Make sure let me know if you think I got anything wrong in my assumptions. Let me know in the comments. If not, I really want to thank you for taking the time. So like and subscribe to the channel. This is it for today. I'm Giacomo. This is Hustle Hub. See you next time.